Thanks for clicking! With the Bank of Canada set to cut interest rates, to fix or float will be the big mortgage question facing borrowers. This according to a recent article in the Financial Post.
And what about what I want?
Indeed, in the Post article comes as Canada received weaker than expected GDP data late last week, with many arguing that data means we will in fact be seeing a rate cut at Wednesday's announcement. TD's James Orlando said that we should expect fireworks. And, although in contrast to the media's predictable hyperbole, in that markets are still only pricing in a 38% chance of a rate cut at Wednesday's announcement, it is possible that the Bank of Canada cuts this summer.
Guaranteed.
And, given that we're likely to see a return in the popularity of variable rate mortgages, I think it's worth briefly going over not only the Financial Post's article, but also some context. So what I want to do today is go over the Financial Post article, as well as its math, go over some key arguments we're likely to hear when the Bank of Canada cuts rates, and then discuss some implications. The Bank of Canada is set to make that much anticipated interest rate announcement on Wednesday, with a press conference coming thereafter, and we'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this article. On to the article. The Post begins by noting that a Bank of Canada rate cut on Wednesday could be a game changer for families everywhere.
And your world will change forever.
Well, a 25 basis point rate cut I'm sure would be welcome news for those with variable rate mortgages, but I'm not sure it's a game changer. Take a $500K mortgage at say prime -1, payments would drop by about $70.
Change the game.
Change the game.
Regardless, the article says that once the Bank of Canada pulls that trigger, that variable rate mortgages could steal the spotlight. And, says the article, given the latest interest rate expectations from CanDealDNA, the numbers lean favorably towards variable rate mortgages. So, what does the CanDeal data say? I don't know, as it doesn't look like it's freely available. But the Post article says that variable rate mortgages could save borrowers up to $6,000 based on the CanDeal projections. Now, while $6,000 does seem like a lot of savings, I don't know about you, but I want to see the data, especially coming from the Post, which, as we've talked about before on this channel, either can't or doesn't read the polls it references. And I want to see the data even more so, given that the article in question doesn't exactly understand government regulations, stating that borrowers are choosing 5-year fixed over 3 years, as it's easier for borrowers to qualify due to the government stress test, which is ridiculous on its face, as the stress test mandates that borrowers qualify at 5.25 or 2 points above their contract rate, whichever is highest, and given that a decent 3-year fixed is sitting at 5.55 and a 5-year is sitting at 5.14, borrowers would have to qualify at 7.55 for a 3-year or 7.14 for a 5-year. Take away that stress test, take away that plus 2%, and it's still easier to qualify for a 5-year mortgage than it is a 3. It's not the stress test making it more difficult to qualify for a 5-year. That would be the inverted yield curve. But I digress. Given the Financial Post's chalky history with literacy, as well as its inept explanations of government regulation, I would prefer to have seen the data when the Financial Post says that borrowers could save $6,000 over the next 5 years. So let's very briefly run our own, link in the description so you can double check my work. By March of 2026, using the latest available data from CDOR Movements, there is a 43% chance that rates will have dropped by 125 basis points. For our purposes, let's assume we're the media and pretend that means a 100% chance that the bank will have cut rates by 125 basis points by 2026.
He's right.
So let's use a $500K mortgage using the 5.14% interest rate available from RBC, and we'll sprinkle in 5 rate cuts over the next year or so. Coincidentally, 5 rate cuts by March of 2025 is also what's expected by the Bank of Canada's Survey of Market Expectations. As for savings, looking at the fixed versus variable, fixed still wins out, though barely, saving $74 if the bank cuts rates by 125 basis points over the next 14 months.
A week, maybe.
So, right now at least, using the data that's available, fixed and variable are going to perform about the same over the next few years. Now, I'm not sure about the CanDeal data mentioned but not referenced by the Financial Post, but it does appear to be more optimistic, suggesting $6,000 in savings by taking a variable rate mortgage.
Have I ever steered you wrong, Jim?
which very well could be the case if the Bank of Canada cuts rates by more than 125 basis points over the next 2 years. But we really need to take this stuff with a grain of salt. The markets may know marginally more than you and I, but their track record, in many cases, is even worse. At the end of 2022, the Bank of Canada's Market Participant Survey thought that we'd be sitting at a policy rate of 3% by the third quarter of 2024, which of course we're not. In February of 2022, Rob McClister, author of the article in question, said that if inflation lingered, the Bank of Canada could raise rates by 200 basis points. The bank then went 475. Back in 2020, McClister said that buyers owed it to themselves to consider variable, as HSBC was offering 0.99%, and the Bank of Canada pledged to keep rates low until 2023. A 5-year fixed at that point was 1.39.
Don't be stupid.
And I bring this up not just to poke fun at the media in the real estate industry, but rather because we're going to see more and more articles like this, especially when the Bank of Canada cuts rates, like the one we saw about the secret variable rate being offered by TD a few weeks ago. So secret that it was on the front page of the Financial Post for 3 days straight. And as a general rule of thumb, if the real estate industry, if the media is pushing something, it's worth getting into the details. It's worth getting into the nitty-gritty. It's worth getting into the data upon which these arguments are based. And the article in question doesn't give us any specifics. It doesn't give us much details. How much do rates need to fall? By when? What's the likelihood of that happening? Only noting that according to the CanDeal numbers, which it doesn't list, variable rates are favored. And that's not even to mention the multitude of unknowns heading into 2025 and 2026. Inflation is still not back at target, US debt is becoming more and more of a problem, and the US election has the potential to swing things wildly. And we're still not sure on the path of the Canadian economy. All of these are great big unknowns that aren't mentioned in any of these articles pushing variable rates. Given the low to 2023 debacle which the real estate industry bought hook, line, and sinker, without giving a moment's notice to the underlying argument, if there was one would think that a bit more time would be devoted to the actual numbers, the underlying data, this time around.
That is not my job.
So, as time goes on, if the Bank of Canada cuts rates in June or even July, we will probably see an upsurge in variable rate popularity. And there's nothing wrong with that. Variable rates could in fact perform better over the next 5 years. With that said, let's look at the actual numbers, let's look at the actual underlying data, and then let the borrowers decide. Give Canadians as complete a picture as we can, and then go from there. With that said, whether or not the Bank of Canada will cut rates on Wednesday remains to be seen, but we'll obviously have that update on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.